Good morning, Bitcoiners, and welcome back to your economic calendar, where we cover the news and analysis you need to start the week off right in Bitcoin. Today is Monday, July 5th, and happy Independence Day to our friends south of the border who are celebrating the long weekend. As we know, Bitcoin takes no holidays, so we have a pretty special episode for you today, and it's going to be a pretty active week in the markets. In today's episode, we're going to start by talking about what Bitcoin and bond yields have in common. We're going to check in back on the relationship between Bitcoin and US Treasury bond yields and what that may have in store for Bitcoin in the near and medium term. We're also going to be talking about the S&P 500 and the NASDAQ, which are both at all-time highs as we head into earnings season for Q2 in the coming weeks. And last, but certainly not least, we're going to address some of the changing dynamics in the stablecoin world, where there's some shifting dynamics in there that may have some implications for Tether and crypto markets in general. So we're going to discuss that as well. So grab your coffees. It's going to be a good one today. So starting as we usually do with Bitcoin, we see that surprisingly, Bitcoin had one of its least volatile weeks so far this year. Last week, with prices ranging from a high of 36,623 to a low of 32,700 before settling to end the week at $35,289 last night, up 1.70% for the week. Now, interestingly, we saw that both Ethereum, so here's Ethereum's weekly chart, up 17.21%, as well as the DeFi index, up 21.31% last week, both outperformed Bitcoin to the upside by a long shot. We're going to be diving into this in more detail in our DeFi section later today, but we're also going to be going into further Bitcoin analysis. So as we've covered here before, let's just go back to the Bitcoin chart. As we covered here before, Bitcoin tracks inflation expectations. So much so that throughout the year 2021, the price of Bitcoin has been more correlated to the yield on the US 10-year bond than it has to S&P 500 or even gold. So let's just check that out very quickly. We're just going to throw these comparisons on the chart so that we can see the difference. So as you can see, the yellow line here is the yield on the 10-year note, the orange line is the S&P 500, and the blue line is gold. So as you can see, now the correlation is by no means perfect, but you can see that Bitcoin is very, very much more correlated to the yields on the 10-year US bond than they are to either the S&P or gold. Now, because Bitcoin tracks inflation expectations, and as we've mentioned here, because it tracks inflation expectations so closely, we pay a lot of attention to inflation data as well as asset prices and to any of the market forces or dynamics that drive these two. So recent economic data like the May personal consumption expenditure reading that came out at 3.4%, as well as the 5.9% drop in new home sales for May, in addition to lumber prices being in free fall, have all strengthened the Fed's view that inflation could be transitory. So again, all the recent economic data that's come out seems to be reinforcing this Fed view that inflation is transitory. This has appeased inflation expectations and caused Treasury bond yields to settle in much a similar way as we have seen Bitcoin prices settle. I'm just going to remove these comparisons here just so that I can show you the 10-year yield. So as you can see, the 10-year yield has been pretty much on a stabilizing to down trend since pretty much March 15th, or end of March really, which is somewhat similar to what we're seeing in Bitcoin. So Bitcoin has been essentially in a somewhat of a downtrend since around the same time. So it's interesting to see the correlation between the two. Now, having said all of this information, or having shared all of this information that reinforces the Fed's view, there are still signals that point towards more potential inflation, or that somewhat may contradict this view. For example, while new home sales volumes dropped in May, home prices continued to soar. And for that, I just wanted to highlight here, the graph you have behind you is the US National Home Price Index, which, as Sam Rose says, are going bananas. And they are going bananas in the sense that they are at their highest level since the mid 80s. So again, this is just home asset price inflation. Now, similarly, let's examine the prices for hot rolled steel in North America. As Javier Blas highlighted here, prices for hot rolled steel in North America are up 255% since June 2020. And lastly, there are other factors that are in the market that could cause the inflation and the inflation narrative to resurface. One such factor is the amount of pent-up savings in the U.S. consumer. Again, so in the graph you have behind your screen right now, it shows that there are about $2.4 trillion of accumulated savings in excess of pre-pandemic levels that are sitting with the U.S. consumer, and these could be getting spent in the immediate future. If this happens, this would cause monetary velocity to jolt back into life and drive asset and consumer prices even higher. Keep in mind that monetary velocity has been very subdued throughout the pandemic because people aren't going out and spending money. A big part of inflation is how quickly that money changes hand. So as people start getting more active, velocity could come up, so could inflation. So again, we've covered a lot about macro here today, but we're going to be diving into what we are seeing in the Bitcoin derivatives markets in our What's Ahead section later today. Moving over to the S&P 500, we see that the index absolutely soared last week, up 1.47%, closing at 4,349 points. And we see that it seems to be off to the races again this morning. Now, interestingly for the S&P, this was the second consecutive all-time high in a row, back to back, as we can see here. Now, checking in on the NASDAQ, we see that last week it also soared, and it's up, or it finished the week up 2.67% at the NASDAQ, capping 3 consecutive all-time highs, 1, 2, and 3, which is very, very impressive, and especially considering that it closed at the session highs, meaning there could be some pent-up buying demand there. Now, as we've been covering, and as very well exemplified by the NASDAQ here, the rotation back to technology from industrials and commodities continues to play out. The leaders for the move higher last week were companies like Apple, you can see up 5.15% last week. We see Amazon, again, up 3.22% last week at the highest close ever. So this is a record high close for Amazon stock. We see that Facebook was also ripping much higher last week, up 3.9% into uncharted territory. Again, this would be the second back-to-back all-time high week for Facebook. And then lastly, we see the other usual suspect is Google, up 1.35% last week, and again, at a second consecutive all-time high. Now, interestingly, as we saw, the technology stocks that are not at all-time highs are within dollars of their all-time highs. So again, just illustrating this narrative. Now, another tailwind for U.S. equities was the fact that U.S. Treasury yields, or particularly yields on the 10-year note, dropped dramatically over the last week. As you can see, here's the yield on the 10-year, down 6.71%. That's a massive move on Treasury bond yields. And again, so this also helped indexes or equity markets in general. And then this yield on this 10-year note itself is actually sitting at 1.43%. Interestingly, again, this is the lowest level that this yield has closed dating back to February of this year. So, very interesting to see. Again, this closed the week, or this closed the closing price was essentially within cents or within inches of the lowest of the session. When that happens, it typically means that there could be pent-up demand on the sell side for the next market session, which would be tomorrow. The U.S. markets are on holiday today. That's something to keep our eyes out this week as markets re-engage tomorrow morning. Now, or U.S. markets rather, Bitcoin never sleeps. So looking elsewhere into the equities space and what could potentially be affecting these markets in the near term, we do see that earnings season for Q2 is off to a light start. So we've started seeing some reports for Q2, but again, very, very light. And the activity really picks up 2 to 3 weeks from now when the meat of all the reporting actually happens. Right now we're seeing about 5 to 10 companies report per day, and it grows into days where there's 200 to 300 companies reporting on the same day. So that happens in 2 to 3 weeks times. So again, just to spend a minute on these potential earnings reports. So according to data from FactSet, the number of S&P companies giving positive guidance is at an all-time high. And there could be some fireworks in Q2 earnings announcements, which could be very positive for the markets. This is the chart that we are depicting. So the chart below tracks essentially positive guidance from S&P 500 companies in a number of companies basis. And it's showing data all the way back from mid-2016. And what we can see is that the number of companies giving positive guidance is at an all-time high. So again, that means there could be some pretty impressive numbers and potentially some fireworks during these announcements, which could cause the markets to potentially rally higher. Now, having said this, all signs point to a roaring US economy and a positive earnings cycle for Q2. US equity markets seem to be in great shape, and US equities are essentially quietly leaving all other equities globally in the dust. And we wanted to highlight that for a second, just to show just the magnitude of the difference. So the chart behind your screen right now basically compares the US MSCI index. So it's just an index for US equities, and it's comparing that same index, the same style of index that is tracking the United States is being used to track equities in the EU, Japan, the UK, the US, and emerging markets in general. So as you can see from the chart behind you, or the chart behind your screen, US equities are performing at an almost 3x, so 3 times better than the next equity set. And this dates back to all the way in 2009. And the second best performing one is the emerging market one. And just based on the economic data that we're seeing, it does look like this trend may continue for the foreseeable future. So, as we've said, just taking into consideration all the things that we're seeing in the market right now and how companies are setting up for this earnings season, this season and this cycle could reinforce the inflation narrative as companies would have to then compete to essentially continue growing their talent, and then having great numbers would give them pricing power to potentially raise prices. So interesting to see how this plays out. We'll keep you in the loop as the earnings cycle for the S&P starts in earnest in the coming weeks. Moving over to gold, we see that last week it had a positive week, closing at $1,787, up 39 base points. The price action that we saw last week contradicted what many thought was going in or was going to happen going into the week last week. And we saw that gold rose rather than dipped. The week was somewhat volatile. It did show like it was going to dip, but it recovered and regained, closed the week higher. Now, the close was actually bumping right up against this trend line that we have highlighted dating back to August on the downside. But the price action this morning seems like it is, or if it were to close the week right now, it would essentially be breaking through that resistance. But the week is still very long, so we'll see if this holds. From a technical standpoint, it looks challenging, and so it may face some more pressure on the downside. Now, just the chart just looks somewhat fragile going into the week. But now, going into sort of zooming out for a second from gold, Lynn Alden pointed out this week, which I thought was an excellent tweet to share. As she highlighted, and as we've covered here before, gold continues to have an almost perfect inverse relationship with the real return of the US 10-year note. What is real return of a bond? The real return of a bond is essentially the interest rate of that bond minus the expected inflation, or the inflation rate for that bond. So now a couple of things become clear from the graph. One, the real return from a 10-year US Treasury note is currently negative. It's negative to the tune of around between 0.5 and 0.1%, so to the tune of 70 base points. And that's negative real return for that yield. So when the real yields rise, that means the interest rates are rising faster than inflation, and this hurts gold. When real yields drop, it means inflation is rising faster than rates, and meaning that gold thrives. What this could also imply is that as the real return of treasuries gets more attractive, investors leave gold for the safety of treasury bonds with a real yield. So it's going to be an interesting week for gold, but we'll keep you in the loop of any interesting market moving news on this sector. Moving over to the DeFi index, we see that last week, both the DeFi index, so we had a green candle here, and Ethereum both caught a bid and closed significantly higher in the DeFi world. So if we're just looking at the index for price action last week, we closed the week higher by 21.31% at 7,577 points on the DeFi index. Looking at Ethereum, we closed last week up 17.21%, up $341 to close at $2,324 per Ethereum. Now, there have been some really interesting news on this side of the industry. Namely, a couple of the ones that we wanted to highlight was that one is the headline that came out from Skybridge Capital and essentially Scaramucci's fund, Anthony Scaramucci's fund. He announced, or the news broke essentially, as you can see the headline behind your screen, that Skybridge Capital, he is planning to launch an Ethereum fund as well as filing for an Ethereum ETF. Now, until now, most of the ETF conversations had gravitated around Bitcoin. And it will be interesting to see if this has an impact on how the SEC approaches ETF applications for digital assets in general. Now, another very interesting headline that we highlighted last week, but that we think it's important to show how this is continuing to play out, this trend, because again, we think could be a very important trend if it continues to build this narrative. And as we highlighted last week, there seems to be a seismic shift happening in stablecoins. In line with our comments last week, reports are now surfacing that are projecting that in a couple of weeks, Tether's overall supply dominance on the Ethereum network relative to on stablecoins issued on Ethereum, Tether's dominance of this could fall to under 50%. So right now, Tether makes up way more than 50% of all stablecoins on Ethereum. That dominance is shrinking. And some analysts are projecting that in 2 weeks' time, Tether may hold less than half of the total stablecoin supply in Ethereum. This is really, really important in the sense that Tether has held the dominant spot on stablecoins for quite some time, and it does seem like it's beginning to get challenged by some of its competitors. Parallel to this, we continue to see exponential growth in the supply of USDC, so the competing stablecoin by Circle, the one that Ledin uses, that is a fully compliant and regulated stablecoin. Now, investors seem to be talking with their feet, and it would not be surprising to start reading about Tether's redemption mechanisms and redemption scrutiny in the coming days and weeks. This would be just a natural progression of this narrative. And this could also introduce volatility to Bitcoin and crypto markets in general. So it's very important to stay on top of these developments. And moving over to our Bitcoin mining difficulty commentary, if you don't already know or haven't already read about it, there was a very large downward difficulty adjustment in the Bitcoin network last week. Specifically, mining difficulty dropped by 28%, and it was covered in some quite broad mainstream media, and great headline here by CNBC. First off, kudos to the CNBC editorial team for the headline, as it captures the nature of difficulty adjustments beautifully. So the headline reads, Bitcoin mining is now easier and more profitable as algorithm adjusts after China crackdown. So to talk a bit about the details of what happened and the actual adjustment itself. So after the China move to essentially eject mining companies from China, about 54% of the mining hash rate for the Bitcoin network left the network. What that means, or what the protocol does, is that the protocol adjusted to make blocks 28% easier to find. What this means is that the remaining miners that are left are now on average more profitable than before. And this incentivizes new hashing power to come online. Now, this new hash power will come online in more welcoming jurisdictions with hopefully less corruption, cleaner energy sources, and a better long-term plan. So we do believe this is a net positive for Bitcoin over the long term. Now, switching gears to the mempool, we see here that the transaction costs have come up a bit, but they've actually seemed to be normalizing quite quickly this morning. And just to do a quick check on next block confirmation times, right now you can get in the next block for 14 Satoshis per VByte. So pretty efficient transaction costs right now. And as always, we leave you with what's ahead for the week. So as summer starts in earnest, we're starting to see the Bitcoin futures curve start to steepen. And I wanted to show you this quickly. So what you have in the back of your screen is the futures curves for Bitcoin across different venues. And similar to what is happening in the treasury and bond curve, but on a month, not years basis, the the Bitcoin curve is steepening as investors start perceiving that Bitcoin could grind higher increasingly sooner and sooner. So as essentially the fall gets closer, that steepness of that curve moves more towards the front of the curve. That started to, it looked a bit cleaner essentially yesterday or over the weekend. This morning with the down move, we're starting to see some more backwardation back in the curve. But really, if we look across the board, we're really only seeing backwardation in really 1, 2, 3, 4 curves out of 9. So the curves themselves are starting to steepen gradually, which is healthy in Bitcoin terms. So as you can see, like there's a bunch of curves that are already trading back in contango. So CoinFlex, FTX would be some of them, even Binance. We're still seeing some backwardation on Deribit, OKX, and some of Kraken as well. But again, these are signs that the market is expecting some more stability as the summer ends, and potentially prices to start picking up towards the end of summer. Now, looking at other interesting market dynamics here, we see the perpetual swap funding rate. This is the one I wanted to highlight here. As you can see, the perpetual swap funding rate. Oh, just give me a second. I'm just going to put the FTX one. So the perpetual swaps funding rates, as you can see, is currently negative this morning, and it's been hanging around the negative for quite some time. It's not that usual for Bitcoin funding rates to hang around the negative for so long. This would be getting close to the sort of longest period of time where this funding rate has remained negative for some time. Now, what does this mean? It means that there are more leveraged shorts than longs in the market right now. Now, we have seen what happens when too much conviction builds on one direction. We're starting to see a lot of conviction build to the downside and a lot of leverage start being used to the downside of Bitcoin. What this means is that all the market needs is a little spark to send shorts running for cover. So it'll be an interesting week and important to keep in mind, or to keep the funding rates and short interests in mind. Now, as usual, let's go through some of the market moving data and events that will be happening later this week. So a quick rundown of what to expect this week. Today is a holiday in the US, so there's not a lot of data or activity scheduled for today. On Wednesday, we get job openings in the US at 10 a.m. and at 2 p.m. on Wednesday, we get the Fed's FOMC meeting minutes. Now, the market will likely react to the minutes announcement as there is typically additional detail in these minutes that was not necessarily included in the official press statement by Powell. Following Wednesday's news, we have more interesting data coming out on Friday with wholesale inventories at 10 a.m. Estimates are for an increase of 1.1% in wholesale inventories. A lower number than that would signal that inventory is cycling through, which could put upward pressure on inflation. A higher buildup than 1.1% would mean that there could be deflationary pressures in the future as wholesalers look to move their built-up inventory more aggressively. So interesting number coming out on Friday. Lastly, on Sunday at 9:20 a.m., we have the Fed Vice Chair for Supervision, Randall Quarles, giving a speech on financial stability and climate change. So as we've covered, it'll be a big week. And as always, we'll keep you up to date with any relevant information right here at the Economic Calendar and through our social media accounts at Hodl with Ledin. If you don't yet have a Ledin account, I welcome you to check out ledin.io and learn how you can earn the best interest rates in the market at 9.5% for your stablecoins and up to 6.1% on your first 2 Bitcoin. We also have market leading rates for our Bitcoin-backed loans and recently started enabling our trade feature in select markets. So check out ledin.io. And again, if you enjoyed the show today, if you like the content, I welcome you to please give us a like, thumbs up, subscribe, and share it with your friends. And have a great week, everybody. See you next time.